You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody, welcome back to the Option Block, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Pretty exciting week we're having here as well. I guess it depends which side of the fence you fall on here. Almost a repeat of Monday's show that we got, it looks like, in store for you here. But we'll get to it, of course. You guys can join us anytime. You want it on demand on your own schedule, and find it on iTunes or Stitcher or our website, wherever you like to get it, our app. You can download and listen at your leisure on your commute, on your working out, and a lot of you guys like to do that. Of course, you can join us live every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern, via the old Mixlers. I never say the URL. It's mixlr.com, mixlr.com/options-insider. For some reason, you haven't seen it on our social media or on our site before, and you want to listen live, there you go. Let's go to that URL, set it and forget it, and you're good to go. However you listen, live after the fact, hit us up, questions, comments. I know you guys have a bunch of them this week. Hey, everyone does. So keep them coming. We'll try to answer as many as we can. And of course, yes, we do. We do like to hear from you guys. And let's spin the old wheel today. The wheel having a hard time landing on some people, as understandably today. Things are a little bit crazy town out there in the markets. Luckily, the wheel has landed all the way out there in scenic and sunny St. Charles, Illinois, where we are joined by Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the Option Block program, sir. How goes it for you this week?
Oh, not too bad. Not too bad. Why did anything happen in the markets that I should know about?
Apple announced a quadruple additional earnings, surprise earnings after the other earnings a day later. It was crazy, unprecedented.
Wow, that's nuts. And then did we still even trade in this market this week? Was there anything worth doing this week?
Kind of quiet, mostly bonds. If you're interested in fixed income, that's where the action was. But otherwise, yeah, pretty quiet week for the markets. I think everyone's gearing up for the big snow day that's coming here tomorrow in Chicago. But let's keep on rolling. We'll see if we can sort out if the Skype gods will smile upon the pit crew over there, because it is time for the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. Like the name implies, this is the portion of the show where we break down what the heck was going on in today's market activity. And it was a lot, going on in today's activity. Kind of a bit of a, maybe we're bad luck on the show, Mike. I don't know, because it seems like every time we get together this week, we are signaling zombie apocalypse time, end of the world. Kind of a similar narrative to Monday. We'll see, of course, in the after hours now if it plays out like Monday. Hopefully not. But we'll see. Of course, we had a mixed kind of day, selling off. Then it seemed like we were going to rally back and get some of that back. And then towards the end of the day, just exacerbating the sell-off yet again as we're coming into the end here. Recording this and streaming it live a little bit after 3 p.m. Central here. The 1-2 time zone, we got most of the major indices off over 3%. Actually, the Dow off nearly 3.5%. Q's off a similar percentage. The S&P, the laggard, only off a paltry 3%. And VIX cash once again back up into the 35 territory. So you've been hemming and hawing, wondering if you could sling some trades out there on the upside of VIX. Today was your day. If you had made some other bets on VIX receding, you had a few moments there, and then things decided to take a turn for the interesting today. But I don't know, Mike, it's kind of interesting. We've talked a lot about these products on of course, volatility views. It's been an ongoing discussion. All the volatility products are kind of the fodder for discussion there. VXX, and of course, its counterpart XIV, which is short vol, and indeed SVXY, which is another short VIX product out there. But this week, I don't know if it happened to you, but it certainly happened to me. I was just inundated with questions about this. And people I didn't even think really traded were suddenly hitting me up about inverse short vol products. I mean, just think about that for a second, how much the retail trading world has evolved just in the last 3 to 5 years. But that said, it seems like we're all living in a post-XIV world, which is, of course, the inverse VXX product, which, of course, infamously pretty much had hit its tailspin right as we were doing our show on Monday. We were talking, and all of a sudden we started noticing, wait a minute, this thing isn't done. This is after hours are getting extreme. The VIX futures were starting to bid up aggressively, which of course signaled the beginning of the end for XIV. As we've cautioned many times on these kind of Frankenproducts that are cobbled together, attempting to somehow approximate another product out there. They have all sorts of weird caveats in the provisos in their funds. And of course, if you looked at XIV, you see that an 80% down move could trigger what they term an acceleration event, because it sounds so much better than an elimination or a termination event. Accelerate. We're just going to accelerate. It's the same thing. It's going to wipe out all your capital. But hey, it's an acceleration event. So that's exactly what we saw. We see XIV. Keep want to say TVIX. It's from the same company, and they also had a debacle a few years ago. So I have TVIX on the brain, but it's XIV, of course. And they're looking for February 20th being the day that goes to the graveyard. SVXY continuing to trade, surprising a lot of people out there. In fact, we have a poll asking you guys about that right now out there on Twitter. Do you guys have any confidence in SVXY? We'll get to some of the results of that in a little bit. But first, Mike, before we even get to what else was catching your eye this week out there in the markets, walk us through the last couple of days. From your clients' perspective, have they all been hitting you up like people have been hitting us up here, just asking nonstop about inverse vol products, or are your clients a little bit removed from that stuff?
They're very removed from that stuff. It's one to where I've been saying for years that unless you want to have a specific trading strategy on the inverse vol products, stay away. Like I know Andrew and Mark, what they're doing, they deem a lot of those products predictively crappy, and they have their own strategy on how they do it. But they're very accurate in how they can be predictably crappy. Now, I had one guy that trades his own account. He had some XIV exposure. We talked about it. He's no longer in XIV. And I know this is going to sound shocking. I don't think he's ever going to be in XIV ever again. But in looking at that, I've not liked inverse and double levered. I've hated all those products for 10 years now. And the reason I've hated them is because they're a great solution from hence there really was no problem in the first place. My thought on if you want to do, even before a lot of the inverse, all these VIX products came out, I mean, I'm not talking about the VIX itself. I'm talking about VXX, XVY, and those products. If you want to have inverse exposure on the VIX or exposure to the VIX, go long or go short the futures on the VIX. It's there. It can do it. And if you're worried about it not doing what the VIX is supposed to do, well, it will do what the VIX is supposed to do because it's the futures on the actual contract. And if you don't like it, then have enough margin in there or maintenance to wait till settlement. I mean, that's my thought on the whole thing. Now, once again, if you're trade-off of the inefficiencies that exist in those products like Mark and Andrew do, totally different story. But if you're looking to have inverse exposure to the VIX or exposure to the VIX, open up a futures account and trade the VIX, for crying out loud. That's my deep philosophy on it. I've disliked a lot of these products. I remember 10 years ago working at Options Express when a lot of these double inverse S&P products came out. And I remember when they first came out, a lot of people were upset about them. But if you read the 9 million page prospectus, they'll tell you in a lot of those products that they're designed for more of a day trading style product. Well, if you want to day trade, once again, open up a futures account and day trade the S&P E-mini. So I think that it's not a good product to have when you're doing it. And in terms of XIV, with what happened to it, XIV did its job, so to speak. I mean, the VIX doubled, and let's just do the math on if it's an inverse product and the VIX goes up double, then in theory, XIV should be at zero. Now, granted, I think it's still at like $5 or something like that, but yeah, I'm sure that they adjusted the contracts in it to where it's not the full exposure to zero. But my point is that if you're looking for longer-term exposure and hedging yourself on volatility and using volatility as an asset class, these products aren't very good for you to do that. If you're looking to trade the predictably crappiness of it, like Andrew and Mark do, hey, God bless you, more power to you. Manage risk like you're supposed to. It's a great thing. But in using these as a longer-term hedge exposure, I have never been a fan from the get-go. And this is just the latest generation of lessons of people. Every 2 or 3 years, we seem to have lessons like this for people that didn't understand the products. And I feel bad for them. But this is one thing to where hopefully maybe people will learn next time, I guess.
Yeah, I've called them Frankenproducts for a long time. I got some heat for it, but it's true. These things are cobbled together, attempting to approximate, which you're right. That's always been my point as well. The actual pure quote-unquote way to trade this, if you want to trade VIX, the futures exist. They're right there, and the options on the futures exist. So if you want that direct exposure to VIX, it's there. So these Frankenproducts that exist with all these weird caveats and buyers beware, and if they move this much, there has to be a distribution here, an acceleration event there. These things, they exist, and I understand why they exist, and people actually have been arguing in defense of them. I think Mark actually wrote a piece for The Street this week doing just that, saying these products kind of performed how they were supposed to. And I think he called the people who didn't like it volatility tourists, something along those lines. And, for a guy like him who runs a vol fund all day, that's kind of his job to understand these products. But that's pretty much what you need to do to really have a firm grasp, or if you're on a show like this. 95% of the investing populace who's flocking into these things, who see them listed on their broker's platform, alongside SPY and GLD and other things that, they all are lumped under the same, effectively ETF. Obviously, some, we're an ETN. It's a little bit different. That distinction's even lost on a lot of people out there. I tend to call them all ETPs, which is exchange-traded products. That covers all of them. But still, they're all kind of lumped. They all see them all as effectively being ETFs to them, in their mind anyway. And they all kind of carry that same degree, I guess you can call it, of safety or reliability that they've come to expect from a thing like SPY and others. And you could certainly argue that these products should not warrant that belief and that viewpoint. People have been arguing to me that they should never have existed. They should never have been allowed. And I could understand that viewpoint. I can also understand the viewpoint that, hey, they did what they were supposed to do, and they weren't covering it up. They disclosed it. Granted, it was 100 pages into a 160-page prospectus, and you had to kind of look at the fine print to understand it. But that said, these things kind of did perform as they did. There's some debate in the after hours as to exactly, why Credit Suisse did what they did. I know Ophir and others were digging around, saw that they actually owned millions of shares of it themselves, or it seems like they panicked and wanted to shut the whole thing down. As a result, they shut the product down as well. So they hedged their exposure with the futures. It kind of left everyone else kind of holding the bag. That's within their wheelhouse. If they want to eat their own dog food and hedge it, they can. But still, yeah, I'm kind of on the fence as to whether, these things, so many people just clearly have no idea what the heck they're doing with these things. And obviously there's a Darwinian component to the street. I like that. People, it's buyer beware. You should know what you're getting. But when they're lumped in there all together, alongside a lot of other products that are much more stable and have a much more reliable return, predictable return, pathway, it conveys a sense of probably safety and security that probably shouldn't be there. And just for my own interest, I was playing around this week. I wanted to see how easy it is for, your random Joe Schmo to go trade these things. I logged into my IRA account, which I haven't done in a while. Probably should do that more often too. And I was playing around with that kind of antiquated, dated platform to see how easy it is for me to just go and if I wanted to just buy VXX or even more as XIV is the one I was looking at. And to their credit, this platform, they did put up a little splash page saying, hey, these are inverse volatility products. You should know, you should read the prospectus, you should understand the risks, click here. So they did do that. Now, this is, of course, after Monday, so I don't know if this was added in haste after all that stuff happened or if they had that all the time. But some of the platforms are starting to wake up to that. And, you can't, brokers need to make money. So they want people to trade these things so they can't really hide them in some sort of ghetto where you can't get to them. But, it is kind of, dubious when this product only exists to have these, these weird moments and then they get wiped off the board. So yeah, I'm with you, Mike. I think at the end of the day, that's what we've argued with on vol views for a long time. If you want that exposure, go trade. I know it's scary to say futures. People get terrified by that. But still, the VIX futures exist. They're out there. And you can also trade the options on the futures. And if you want to do that route, and it's there. You don't need the Frankenproducts. I get the appeal of putting it in your securities account. It's nice and easy. Look, I can buy it like a stock. Guess what? It isn't a stock. It's nowhere related to what a stock is. You can't do fundamentals on it. You can't do technicals on it. It's a Frankenproduct. It exists by pure artifice. And so if people don't get that by now, I think they will. In fact, we have an interesting poll. I'm curious, Mike, your thoughts. SVXY, which is the other big, short VIX product out now, still trading, still exists. In fact, they went out today around 9, sub 10, 9.5. A lot of people thought that one was going to go the way of the Dodo, as well as XIV. Currently, we have a poll out there. We're asking people, hey, what do you guys think? Quite frankly, XIV heading to the graveyard on the 20th of February. SVXY still trading it up. Do you guys still have confidence in this? And more importantly, do you think it'll be trading at the end of the year? So we asked people, Mike, a very simple question. Do you think it's going to be trading at the end of the year? Yes or no? A, what is your vote? And B, what do you think our audience is voting right now? So far, it's only an hour or so in, and it's hot and heavy already.
Well, if it's still trading now, then I would say it has a good shot at trading at the end of the year. I don't follow the product very closely or, well, at all for that matter. So I will say that I will go out on a limb and say that, yes, it will be trading by the end of the year. And I think our audience said the same. But I'm saying that with almost zero confidence whatsoever.
I agree with Mike Tosaw. I will say that.
Uh-oh, I hear the voice of the Greasy Meatball. Mr. Meatball, how are you doing? Are you surviving this week, sir?
I am surviving this week. I also just survived an airplane flight that was delayed, which is why I was not timely. I apologize. But, yeah, it was fun. Let me tell you, there's nothing like getting on an airplane down 18, getting off airplane down.
I was going to say,
100.
that had to be a nail-biting plane ride for you.
No, I was relaxing. I was listening to the History of Rome podcast, closing my eyes. The stuff that I had set up within our fund, pretty lock solid where, as long as things got really extreme one way or the other or just meandered lower, right, like I was going to be happy. That's what I will say about this market is that, it will, vol will meander lower, plummet lower, and spike higher. It tends not to meander higher except for at very, very low levels. And we saw that a couple weeks ago, and that meandering higher led us to this, I would say, interesting market where we now have a blown-up ETN and an ETF that is is 10% of itself. So, I'm with Mike though. I think that I can find it hard to believe that SVXY is going to go the way of the Dodo. Primarily, is in that it helps offset risk more inexpensively for Pro Shares, which also has UVXY and VIXY. So it actually is a nice fit. Although here's one thing I will say. I don't know if you remember this. We used to get a lot of emails like, why isn't there a double short VIX ETN?
Yeah.
I don't know.
Not going to see many of those in the offing in the near future, I don't think.
But you remember we got that email a couple times.
Oh, yeah, we got lots of stuff on the short VIX side.
Well, there's a lot of good reasons. Most notably is an inverse can't lose more than 100%. And so a double short vol would basically produce going out of business, probably at least once a year.
if that. Now, Mark, before you came on, Mike and I were kind of discussing the ongoing debate about whether these inverse vol products, some people are very up in arms about them, saying they should never have been approved, never have existed. I know you kind of fall on the other side of the fence. In fact, I think you wrote a piece defending these on the street. I believe you called the people who didn't like them vol tourists. So why don't you go ahead and lay out your case here? Why should these products, these Frankenproducts, why should they exist as opposed to people just slinging the futures and the options on the futures all day?
Well, I mean, the vol tourist thing, I'll be honest, I stole from the Thompson twins.
I had a feeling that did not have a Sebastian air to it.
Yeah, that's stolen from the Thompson twins, I'll be honest. But, they do serve a purpose. They serve the purpose of they will get, if you manage yourself well, 90% of the time, if you manage yourself well, they will produce abnormally high returns, right? The cost for that is you are taking the other side of a volatility event. Now, sans these ETNs, there's nobody to take the other side of a volatility event. So, think about it, right? As much as we complain about all the put sellers and things like that, they provided a service in that, people looking to hedge could do it far more cheaply than they might have expected to do. So I line up on the camp that these do have a place. Obviously, I think they belong with an investor that understands what they're trading. If you talk to Mike and Matt and myself, there's not anybody who I worked with or was, under my, at Carmen Line, there's no way we would have had a SVXY position after what happened on Friday because things had gone backward. So it's not like the market doesn't give you a chance to get out and tell you that things are bad. This is the result of an uneducated public that poured money into something they thought was a bottomless pit of money that got a bit of comeuppance. And what this will do, and I think I laid this out pretty distinctly, what this will do is we will now have, at least for the next couple of years, a contango that in VIX that we are more used to once things normalize. We will have backwardation for a while. We'll get honest premium spreads for selling puts. And, this was right for normalizing the market. But yeah, I am fully on the board that all the sanctimonious talk is basically people who don't know what they're talking about in defense of investors who invested in something they didn't understand.
Well, that latter part, I could certainly agree with. It seems like, just judging from the people who are hitting me up this week and who I didn't think even traded, let alone slung inverse volatility, that a lot of people got into these products. That I would say the vast majority, perhaps, got into these products having really no idea what the F they were trading, or the fact that there were these provisions built into it that it could be liquidated with an 80% move. Even though we've been, advocating against these things for a while on shows like Vol Views and saying, hey, read the prospectus, know these things. They do a good job of burying it. I think it was 80 pages into like a 160-page prospectus where that acceleration, I love that terminology, acceleration event was buried. So I think there probably is an argument there to, at the very least, brokers they can't stop people from trading these things, obviously, nor do they want to. That's how they make their money. But, somehow educating the populace a little bit more. I do think, given what's happened now, I think we're probably going to see more of a regulatory crackdown. Folks at the CBOE had to put together a hastily assembled last minute after the Bell news conference yesterday to kind of walk analysts off the ledge because everyone's assuming this is they're also blaming the CBOE and the products for causing the sell-off. So there's a lot of craziness swirling around there. And we know when there's craziness in the financial markets, there tends to be a lot of regulatory backlash, informed or perhaps misinformed. So I would not be surprised if we do see some of that coming. At the very least, I don't think we're going to see. I think Credit Suisse will try to roll out XIV2 in some way, shape, or form because clearly it works for them in the near future. But I don't think we'll see a lot of people maybe piling into it, and also a lot of new funds diving into that space. Unless some people are going to say, hey, there's a huge void being left unfilled by XIV. Let's go do it. So the ETF space, I've learned, if nothing from going to that big conference last week, it's nothing if not cynical. They see a niche they will fill it regardless of need or risk. So a lot of interesting stuff. That aside, we could probably debate this endlessly. I'm sure we'll talk about it more tomorrow on Volatility Views, but this is kind of the topic everyone's got on their mind. But it is, of course, earnings season. It seems a lot of that got lost in the macro madness that was this week's trading. We had names like, Tesla, Chipotle, Twitter actually coming out with good numbers, just getting wiped away in the day's madness. Twitter is like spitting into the hurricane. Snap also looking pretty good, surprising a lot of people. None of that matters. It's got to be a shame to report good earnings in just the maelstrom of a market where it gets mitigated or wiped out as a risk fund. Oh, and also, I'm sure, Mark, you saw this. This is in your neck of the woods. The Vol fund that won the Pinnacle Award, which is a managed futures award, but they gave it an award also for best option strategy. Guess who won the Best Option Strategy Pinnacle Award last year in 2017, Mr. Sebastian? I bet you can't guess.
I'm going to guess LJM.
Yes, exactly. They won the Best Option Strategy Fund at the Pinnacle Awards last year. I think we all know these award shows are kind of a bit of dog and pony shows. That puts a lot more, I think, grist in that mill there. But clearly they didn't really have any risk mitigation plans. If you have a fund that could allow itself to lose 80% of its capital like that, clearly you're doing something a little bit wrong. I saw an interview with the CEO a while back where he was beating that mean inversion drum again. Whenever I hear that, I have the hair on the back of my neck stands up. I get feelings of long-term capital again. That seems like that's what happened there as well. That aside, before we move on to the odd block, Uncle Mike, anything catching your eye aside from inverse vol ETFs this week?
No, I mean, the main thing that I would say is catching my eye is we closed right around a 10% pullback off of an all-time high. So I think that's a key number, and tomorrow is going to be a key day in terms of seeing if we bounce off of it or if we continue to go lower.
Mr. Meatball, same question for you. Did anything really outside of the madness? First off, is your new fund, is it launched yet, or are you still waiting on that?
No, but and thankfully not. I mean, we would be in fine shape because of our hedging, but talk about timely sitting in cash. We're going to launch it with some probably next week at probably the best time to launch, wouldn't you say?
Yeah, I was going to say this week might be a little challenging to launch the new Vol fund.
Yeah, but our old Vol fund is having a great couple of weeks. We've managed to really take advantage of what's going on in SPX and UVXY and VXX and VIX. So I'm pleased with how everything has traded itself. Now, we had a lot of legacy stuff that we were maybe hoping was going to end up being worth something that is. I'm just going to go out on a limb, Mark. I know you'll be shocked. The February 12 puts will probably go out worthless.
Crazy town, sir. What's crazy is,
I know.
Is it a week ago that would have sounded ridiculous?
And can I actually make a comment about, there was this belief earlier in the week that this was all related to XIV, this sell-off. And I'm going to unequivocally say that it is far more related to movement in the 30-year bond. XIV maybe probably was the poop cherry on the crap sundae we were eating. But most of what we're really seeing is far more related to the fact that 30-year bond has gone from 2.6 to 3.15 in a week and a half, and the 10-year is 2.9. So you can almost equate every move that we make directly to the moves that we see in the bond market.
I was of a similar inkling when everyone's laying this feet. They like to do it. They like to lay it at the feet of the derivatives and related derivatives products. Credit Suisse coming in the after hours on Monday and proceeding to scare the hell out of everybody by driving the VIX futures term structure up across the board. That didn't help. I'm gonna go out on a limb and say that wasn't the best thing for market confidence. Everyone's like, what the heck is going on? This is way worse than we thought. So that didn't help. But yeah, clearly laying it all on the feet of just these inverse vol products. Certainly it's going to trigger other events and I know some programmatic selling was triggered as a result of that, but certainly not today with the sell-off we saw at the bell. I don't think you can lay that at the feet of XIV and SVXY. The term structure is already kind of rich out there. They can't jack it up the way they did on Monday yet again. They could jack it up, but nowhere near the levels they saw before. Really quickly before we roll out of the trading block, we were planning to talk about some earnings. Other things took precedence, go figure. But there are some names popping off after the bell today, including some names I know a lot of you guys like to trade. NVDA, I know that's been a big option pit one for a long time. We started talking about this one, I think it was about 2 years ago at CES, when all of a sudden they seemed like they just roared out of that conference with everyone waking up and saying, hey, they need mobile chips for a lot of things out there, and NVIDIA makes them. Let's go buy them. And they've kind of been on a 2-year tear ever since. They were pricing in about $18, so right around 8% toward the close for their earnings. They closed right around 217 or so. They took it on the chin, off 5% intraday already, and it seems like they're rebounding a bit in the after hours, up nearly 7% in the after. So they're pricing in about 8%, up nearly 7%. Seems like the market liking what we're seeing. It does seem like all these good earnings we're seeing are kind of just like spitting into the wind. It's not really doing anything. Maybe in aggregate, if we get a few more of these tonight after the bell, it will stem some of the bloodshed. Also, Activision Blizzard. This was a name I used to be one of the more reliable premium sales. You could do bullish risk reversals. You could do a lot of fun things out in this name, as long as it had a short put leg to it, and it worked pretty well back when Activision was trading around $14. This is one of my favorite names. Now it's way beyond that. It's trading 65, almost 66. They, of course, are the big video game publisher and make like Call of Duty and all that stuff. Also Blizzard, so they make, World of Warcraft and all that stuff. They were pricing in. They closed around $65, $66. They were pricing in about $5.50, so right around 8% for them as well. They closed off today about $3.50, and in the after hours, they're up about 3.5%. They're up almost $3, about $2.50. So not quite, about halfway of what they're pricing in for their straddle. So a little bit of green on the screen in the after hours. We'll see if that's enough to turn the tides as we keep on rolling right on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, get ready for the Odd Block. I'm going to do a quicker one today because obviously we have a lot of other things to talk about there at the top of the show. But there was some interest. People, days like this, especially with earnings yesterday, people are always asking us, what's going on, those crazy cakes, Tesla catastrophe puts? So let's go dig in and see exactly what was going on to kick things off there. Tesla, of course, closing $3.15 today, so off $30. About 8.5%. Not the best day for the Tesla fans out there. Feeling it a little bit today. And were people slinging these 50 catastrophe puts? Yes, they were, to the tune of 1,065 of the January 2019 50 puts going up. Again, OI right around 37,000. So somebody liking these bad boys today. They went out 60 at 65 cents. And their longer-term counterparts, their partners in crime, the Jan 2020 50 puts, also doing about 200 contracts today. That one's already over 7,000 in total OI. So these puts continue to trade, continue to do decent size. And today, especially in the 2019s, that's one of the larger days we've seen in a while out there. So these things, people keep asking us, and yes, they continue to keep trading up there. Some people really loving these puts. I know the new Vol Fund hasn't launched yet, Mark, so they can't be you. But let's move on here to some of the actual UA we saw today. Because really quickly, we're going to go into Union Pacific Corp, ticker symbol UNP. They closed today right around $125, off a little more than $4, or about 3%. This is the name that had earnings a few days ago. They average about 29,000 contracts a day. Today, doing about 113,000. About 20-to-1 calls over puts. So all the action was in the calls. And a lot of that, listeners, came in the March 130s. It seems like somebody is just probably giving up the ghost, maybe the best way to describe this one. There is size OI on the strike to the tune of about 145,000, and someone came in just aggressively hitting these bad boys, hitting bids everywhere they pretty much could on these, and in big clumps, 27,000 here, 27,000 there, doing a total of just a little bit under 90,000 on the day of these bad boys. So it does have the whiff of perhaps someone giving up the ghost. Also worth noting, they played a little bit in June. Someone did as well, to the tune of the June 130 is also doing about 10,000 contracts. Of course, it is interesting to note that a lot of this paper, this OI, was opened not that long ago. So if that is the case, then perhaps they are piling on. Maybe someone deciding, you know what, it could have been an earnings play, in which case they're closing it down. That's probably the more likely scenario. Or they decided, 150,000, not enough for my blood. I need another 90,000 on this strike. We'll keep an eye on this. I'm going to lean towards closing. But you never know in times like these. Let's go back and look at the chart here for good old UNP over the past year. Been a bit of a turbulent year. They started off the year last year right around 107, 108 bucks. They got as high going into earnings. Earnings was late January, and earnings was pretty much their high for the year, about 143, and they pretty much got clipped right after that. Haven't really looked back since. The trade, like I said, right around 125. Right now. So, Mr. Meatball, you think this is someone who had all sorts of grandiose dreams for UNP and decided to cut them short, or you think they're piling into more here?
Oh, I think they're getting out of the way of a train. Get it?
I do get it. I do get
getting out of the way of a
your
train.
very subtle humor. You don't get it, listeners. Union Pacific, they do a lot of trains, train business. They're in the choo-choo business, Mr. Sebastian would probably say. So, yeah, I don't know. Interesting stuff. It probably has a whiff of closing. But we shall see tomorrow for sure. Let us know if you have thoughts here. Meanwhile, I said we're going to do abbreviated because we got stuff to get to, including it's Thursday. We got to squeeze in some Uncle Mike time. It's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody. Welcome to the Strategy Block. This is the portion of the show where Uncle Mike takes the reins and dispenses some options, wit, and or wisdom. This is also, unfortunately, the portion of the show where sometimes of this week he's in the mobile RCM Wealth Advisor's office, in which case sometimes the connectivity can waver a little bit. So let's keep our fingers crossed that our offerings to the Skype gods will be accepted. Uncle Mike, sir, what have you in store for us this week?
Out of the many call spreads, what I want to go through today is if you are of the school of thought to where you are trying to buy the dip and you're thinking you want to get back into the market, but you are scared to death. But on the flip side, man, if you could have gotten bought in on this market, on this dip, and you don't want to miss out on this opportunity, it's something to think about. If we still had a 10 VIX right now, I can tell you right now, I would be buying as many SPY 270 calls as my risk management would allow me to do, or something along those lines. But unfortunately, with volatility so high, you're not able to do that in the market like this. Typically, I'm not much of an out-of-the-money call buyer, but when you're bullish, buying calls is a hard thing to argue with, except when volatility is high. And I'm of the school of thought that I think that volatility is high right now. So one thing, I just want to go through one thing that I did on Tuesday. I was in cash going into Tuesday, and so I wanted to get some type of bullish exposure in the ultra-aggressive SPY strategy that I'm doing. But on the flip side, I didn't really want to take too much risk in doing so because when you do that, you lose money if you're wrong. So trying to weigh the balances of not getting too much exposure, but yet still having something in case this market does come back. Looking at selling some put spreads, not necessarily a bad idea. You can sell some put spreads a little further out of the money than you normally could. And if this market does continue to go down, with volatility doing what it's doing, I think it would likely go even higher if we had another sell-off tomorrow in the S&P. I don't think many people would argue with that. But the benefit of that in doing a vertical put spread would be the long leg would potentially go higher. So that was one thought, but I didn't really find anything that I really cared for in either the weeklies or the monthlies or anything like that. So I looked to do some at-the-money calls. That really didn't work. Looked to do some in-the-money calls. That didn't work. But then I noticed at the time that the 285 calls for SPY, and this was on Tuesday, SPY was trading in the low 260s. The 285 calls were trading at 60 cents. Now, to give you some perspective on this, just a week earlier, last Friday,
I'd gotten out of the 295 calls and went into cash going into the weekend for, I believe it was 48 cents or 49 cents. I forget the exact price. But the point is that when doing this, my thought was that, okay, so I pay an extra 12 cents from where I was risking to begin with, but I get $10 closer to, or $10 lower of a strike price. I'm okay taking on that risk for the time being. Now, once again, I'm typically not an out-of-the-money call buyer, but I'm trying to protect the gains that I had in January because I had one of the best months of my life in January, and quite frankly, I don't want to blow that. So the thought of doing larger put spreads or putting lots of money on the table in a market like this really does not appeal to me. So anyway, I noticed as the market started going down a little bit on Tuesday, the value of this call is going higher and volatility is increasing. So I actually put out a limit order to sell the 287 call, and this is for April, by the way. I put out a limit to sell the 287 call for 60 cents. Same price that I bought the 285 call for. And it actually almost got filled. It was actually very close to being filled, but then the market started to rally and the volatility went down. I didn't get filled. Now, eventually later in the day, I got filled because of the market coming up. But the point of this story is, number one, to tell you where I'm at with this. And I'm always trying to be upfront with all of my trades, my winners and my losers as best I can. So the first point of this story is to say that manage risk. I think it's very important. Protect your gains. I think that's very important too. But the other part of this is that if you look at the out-of-the-money calls right now, they're very similarly valued, meaning that if you do a vertical spread out of the money on the call side of it, you can do it relatively inexpensively. You don't have to necessarily leg in like I did. I mean, I wasn't initially planning on legging in, but when volatility changed as insanely rapidly as it did, it just kind of, the opportunity presented itself and I did it. So I guess just if you're looking to get some type of bullish exposure tomorrow, perhaps an out-of-the-money call spread might not be a bad idea because of the way that volatility is. Now, of course, this can be old news by the time you're listening to it on Friday, but that is what I was seeing on Tuesday, and that's what I'm going to be looking for tomorrow on Friday.
There you go, Uncle Mike holding court. We got some time left, so let's get some of you guys on the show with a little bit of the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, you guys have lots of comments and questions and things. We also have asked you guys some interesting questions this week. I didn't even pay off at the top of the show there what we were asking you earlier about the craziness that is SVXY. You guys both voted in the SVXY will survive camp. If I scroll down here, I could find the answer. Here we go. As of now, it's pretty tight. 45% saying yes, 36% no, and 19% saying they're hiding under the bed. That was the other choice we gave them. I feel you. So yeah, it's pretty tight. I could see it's arguments to be made on both sides of the fact. I think the fact that SVXY has survived what we hope is probably the worst of it. I can't imagine another event with the futures at these levels, similar magnitude to Monday and what Credit Suisse did. So it seems like if SVXY could survive that, then it could survive through the foreseeable future. That said, I wouldn't touch this underlying with a 10-foot pole. If I did, I would have to hedge it so tightly that it wouldn't be worth doing. I probably would just buy the calls if I had to do that, because I would not be long SVXY right now in terms of that. If you want to take some flyers on some calls or something, hey, go crazy in your speculative accounts. But if you want to long the underlying, I would still hedge this bad boy. I don't have that much confidence to put size assets into this baby. Speaking of size assets, let's see. We asked you guys a bunch of VIX questions this week, including a few days back when the initial madness happened on Monday. We said, hey, VIX moving like crazy. It's already blown past that 23 level we initially talked about earlier in the week. The point was threatening 35. Back at 35 again today. Go figure. So we said we're going to dial up our VIX threshold, ask you guys for a little extra zombie apocalypse fun. So quite frankly, VIX at the time was around 35. It's around 35 right now, so not much has changed. Are you buying or selling these levels? This is important, though. By the end of the week, by tomorrow's close, you think it's going to be in what we term crazy town, so in the 30 to 35 range, in what we call the zombie apocalypse range, which is north of 35, which I guess you can argue, I guess we're there now. Crazy, just pure crazy, which is 25 to 30, or only mildly crazy, which is south of 25. Maybe Mr. Greasy Meatball, there we go. We'll start with you. Where do you fall? You feeling crazy town, zombie apocalypse, just regular crazy, or only mildly crazy?
Zombie apocalypse would be my answer.
Zombie apocalypse. Well, it seems a little more likely today, doesn't it? Mr. Uncle Mike, same question for you, sir. Are you feeling zombie apocalypse, crazy town, crazy, or mildly crazy?
I'm thinking zombie apocalypse tomorrow. Next week, though, I think we will go down to mildly crazy rather quickly.
Yeah, a lot of people were leaning mildly crazy early in the voting, which is south of 25. I think when we saw that initial pullback in the VIX, a lot of people were going that way. Now, of course, we're back up into zombie apocalypse town, which is the north of 35, which has about 23%. Number 2 on our poll. We'll see at this final day if that can push us into that level. 19% saying just crazy, between 25 and 30, and 17% saying crazy town, which is 30 to 35. Yeah, a lot of crazy stuff going on there. A lot of people chatting in the chat about VXX put spreads. I can understand. Option God and Mark B going back and forth about looks like some trades. VXX put spreads. I can feel you on that. Certainly when VXX reset the erosion clock all the way back to pre-split and then went beyond that, it's kind of attractive, I think, to put a few of those in your back pocket, set it and forget it. Long term, we're not talking weeklies or anything like that. I don't know which month you were doing. 15 days out. So you're going a little bit more aggressive. I was thinking longer term, like leaps, but hey, to each their own. I think betting on a little VXX reversion, not the worst thing in the world. That said, today we certainly didn't see that come to pass. I don't know, Mr. Meatball, is that something you're looking at here for the new fund and others? We've talked many times about the VXX erosion. In fact, I know you very famously loaded up on those Jan 10 puts in VXX. Those things, I was actually watching them this week. They were very resilient. They held their value surprisingly well, given everything that was going on in VXX. What are you slinging out there in VXX these days?
We've been doing a lot of VXX back spreads. So. For instance, a trade I was looking at today was long a near-dated call spread versus long a long-dated put spread, and things like that. And that's been about it.
Did you unload your 50,000 10 puts, sir?
Like I said, we sold 500 of those at double our initial purchase price, and have hung on to the balance, and they're still up money. So we have not gone into the dump more of them yet.
No, it's crazy though. Those are the puts that refuse to go away. They refuse to erode them. People buy more at every spike in VXX. They just bid it up. Someone out there has a massive love for that Jan 2019 10 put strike, and they continue to prop it up. So hey, take advantage of it if you can. What do we got here? We've got more questions. XIV stuff. We've got who was this? We've got Todd Morgan writing in saying he doesn't get the fear around the inverse ETFs. He says, I got short vol via SVXY at an average of about 14.9. Underwater now. When vol normalizes in the coming weeks, it will rise again. Less the reset drag, of course. As long as the counterparties don't puke, should be fine. That's a big if there. ProShares held up Thursday, so he said fingers crossed. Yeah, I'm with you. I think we saw the counterparties puking risk is a lot higher than maybe a lot of people factored in. That said, Credit Suisse did put in their prospectus. They could do it, so 80%. A lot of people were thinking it might get liquidated anyway. I think it was accelerated by the fact that they held somewhere around 4 million shares of it as well, so that probably led them into that dark category. But you're right. As long as the issuer, the counterparty there, doesn't panic and head for the hills, these things have a better chance of surviving than it seemed, at least on Monday. This guy asking about the Facebook calls again. Yeah, we talked about that on Monday, the 5 calls. That's kind of a fascinating thing. I don't really know why someone's piling into those 5 calls in Facebook. We speculated on that on Monday's show about that, and we kind of hadn't had a chance to dig in. Obviously, things have been going on. I haven't had a chance to really dig in to the 5 strike on Facebook. Go figure. But it does seem like that OI was open recently. We talked about it on Monday, which is interesting. I think maybe Mike's suggestion on Monday that maybe someone was trying to do an end run around an employee, a prohibition in an employee option or stock selling plan. That could make sense. Seemed like people were gobbling them up, though, a couple of days ago. So there is more paper of these things traded. I think a couple thousand traded not that long ago, yesterday, I believe. So interesting. I want to keep an eye on this strike and see. It's not. We know for one thing for sure, it's not a box or any of the usual things you would assume when you see deep in the money, crazy 175 handle in the money calls. Usually your first assumption is it's some side of box, something like that, but that's not the case. So we're going to keep an eye on those. Maybe when we have a quieter week. These are Jan 2019, so we have some time. When we have a quieter week, we can dig into that a little bit. Meanwhile, if you guys have your own theories as to why someone's slinging size Jan 2019 5 calls in Facebook, have at us, because it's kind of fascinating. Let's wrap up here with a quick question from Johnny Bananas. I love that handle. That's good. He deserves a question just for that handle. He says, quick question. Okay, you get a quick answer. If you buy a put option and the strike price is $5 and then drops to $3, I guess he means, and the stock then drops to $3, is it still worth money even if it's $3 under? Well, he's writing it a little weird here, but I think I know what he's getting at. Uncle Mike, let's educate our friend. People seem to have a lot of questions about when puts work these days. Go figure. What a surprising question to be asking these days. The market's selling off like crazy. But Uncle Mike, let's educate our friend Johnny Bananas. If he buys a 5-strike put, and the stock drops to $3, should he be sad? Should he be happy? What should he be feeling there?
Well, on the put itself, he should be happy. Just because of the fact that it is in the money, and worst case scenario, that put's going to be worth $2.
Exactly. It's $2 of intrinsic value there, Johnny Bananas. So, yeah, you should be happy. It doesn't, where the stock is trading, it doesn't wipe out your option. That's why you buy options. You have this contract. You're guaranteed. Even with these crazy, corporate events that go on, OCC will create some sort of delisting or corporate event price that your options will settle to, a settlement price. So you have that contract in your hand for the life of that option. So take advantage of it. Be excited. Don't be sad. Don't hit us up angry with your puts are working for you, because it's a good thing. You should be happy. All right, let's keep on rolling to our final segment. It is time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, let's do a quick check-in on our friends from the top of the show, NVIDIA and Activision, who were reporting after the bell today. See if we can get a little bit of green on the screen, a little bit of good news. And NVIDIA, just the endless bull story that is NVIDIA continues. Not today, obviously, but at least in the intraday session, it wasn't too bullish. But after hours, they're feeling the love. I said they were pricing in about $18, so that's around 8%. They're up 11.5% right now in the after hours, trading right around 242.5. So apparently the love has not been extinguished for NVIDIA. Let's see, Activision, right about where they were. They were pricing in about a $5.50, or right about 8% straddle, up about 3.5%. So pretty much, actually not even getting back what they sold off in today's session. So not as bullish of a signal for Activision. But then again, you got Beta to think about. By the way, before the open tomorrow, we've got CBOE. CBOE's been getting the crap beat out of it the last couple of days, to put it euphemistically. In fact, they had to have an emergency conference call yesterday to try to, allay some of the analyst fears. Very rare you see that before the earnings. You have a conference call, but it was getting that bad, so they had to discuss it and also address those rumors that they had caused this massive sell-off. So if you're interested in that, watch that one before the bell. Hopefully you got your positioning on. CBOE's been pretty wild of late, so perhaps a more exciting name to watch for earnings than it usually is. That said, let's go around the horn again. Mr. Meatball, we'll start with you. What's on your radar? I'm assuming, I haven't had a chance to check myself. I'm assuming we're not seeing a commensurate move in the VIX futures tonight, like we did on Monday's show when Credit Suisse was unwinding.
No, believe it or not, they actually sold off at between 3 and 3:15 today. 4 and 4:15 for those of you on the East Coast that don't know how to tell time. But yeah, they're off 60 cents after the bell. I'm really interested to see what CBOE does. on one level, things should be really bullish for them, right? Like, this is the type of environment that is great for CBOE.
Exactly.
On the other hand, there's a lot of people out to make VIX products look bad that maybe don't know what they're talking about, and that's bad for CBOE. And that's why people are like, well, why did CBOE take a dive? Volumes are great. This is a bit of a PR problem. This is more of a PR problem than it is a actual problem for CBOE. I mean, Mark, stop me if you think I'm telling tales outside of school. I think if they can get this PR problem under control, the stock's going to go right back up. And so I'm going to watch them, and I like them to rally from here. And then, like I said, VIX futures. I think there's all sorts of fun stuff to do there. Tons of funness.
Lots of funness. You know, VIX is, keeping with the Super Bowl analogy from earlier this week, VIX is kind of like the offensive lineman of the financial markets. When everybody's talking about it, probably not a good thing going on. It's probably something really bad. And so how much you want to bet, you know, a lot of these populist politicians are going to, Elizabeth Warren's and her ilk, who's looking to wind her way towards a nomination coming up here in a few years, probably will have VIX in her, and CBOE perhaps in her crosshairs going forward. So yeah, that kind of stuff is probably what's weighing on the stock. Because you're right. First blush, you hear this, you're like, oh man, this is going to be gangbusters for CBOE. They're doing record numbers, but of course you have the inverse, who are a big consumer of their futures. One of them shutting down, and then of course all the regulatory heat. Usually not a good thing at the end of the day, but we shall see. I'm with you though. I think the drubbing has been a wee bit overdone here. Uncle Mike, sir, what are you keeping an eye on for the rest of this week?
Well, we closed right around the 10% level in terms of a pullback, so I'm going to be watching tomorrow to see if we go below it. Then we'll see what we can do with the 200-day moving average on the S&P and see where we can take it from there. In terms of macro risk or any earnings risk, I don't think that's necessarily the case right now. This is just a good old-fashioned case of selling risk, to put it bluntly. More of sellers than there are buyers, and we'll see how tomorrow ends. Maybe the 10% mark will be the pullback area.
All right, everybody. That music means we've come to the end of another crazy episode, another crazy week in the markets. Hopefully you guys survived. You didn't have all your assets like this. What is it? LJM and others, all their assets in XIV and SVXY and all those other. You listen to our shows like Vol Views, and you planned ahead, and you had a little bit of money maybe in those, and hopefully you took it out or you hedged it, and so you're looking pretty right now. And if you're not, you have our sympathies. But that music means we got to go. But before we do that, one last time around the horn, let's start with the meatball, who's in parts unknown, maybe Paraguay, maybe Utah. You never know where he's going. Mr. Meatball, what's cooking with you guys? I got to imagine you guys are maybe going to do a redux of your VIX Made Easy webinar. That's got to be a popular one these days.
So if you go on YouTube, I did a What Just Happened video. I did a webinar on Tuesday night called What Just Happened. And you can check that out on our YouTube page. And yeah, you know, our broad cap hedge fund, which we're in the middle of launching, which, you know, has a nice number of subscriptions already. We would have started to get long VXX on Friday and been fully long by middle of the day on Monday. So just think about that, right, as you wonder, well, why would anybody pay for active management? The answer is stuff like that.
Yeah, it's kind of interesting. You know, I just came back, especially from that big Inside ETFs conference, and it was so dominated by passive. And maybe a week like this may remind people that passive rides it up and then it rides it right back down. So you have to have a few active intermediary steps in between, hopefully. If you're listening to a show like this, you probably are doing that. Hit them up, optionpit.com, to learn more. Check out the YouTube, and you can go see for yourself. And last but not least, Uncle Mike, you know, I was doing some trading today, and those ticket charges were annoying me. I was working some crazy flyer trades and some crazy names, and I got filled out on one lot out of a bunch that I was working, and it just annoyed me to see that ticket charge there. So if I was annoyed, Uncle Mike, and I wanted to get rid of those ticket charges, what could I do?
You can give me a call, and we can work on that ticket charge, because there is none if you trade through the umbrella that we have at RCM. 312-212-3531, and in terms of the market in general, there's plenty of reason to be fearful. There's plenty of reason to panic. if your financial advisor is anybody but me. Give me a call if you have any questions on it, if you're concerned with this market and what to do in certain situations as such. Once again, 312-212-3531, or shoot me an email at mtosaw@rcmfs.com.
There you go. Hit the man up so you can sleep at night. Let him roll your puts for you so you don't have to. On behalf of Uncle Mike and the Greasy Meatball, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, discussing trades, all the other fun stuff you guys do. And we'll see you tomorrow right back here for vol views and TWIFO. A lot more to get into on those. I think vol views will be very fun tomorrow. Got a fun guest and everything else lined up. So a lot more debate on the vol space to come if you haven't had enough of that. There's more coming. And of course, TWIFO, we'll get into all that good stuff. Probably a lot of indices on TWIFO tomorrow as well. If not, going to see you on those, and we'll see you back here on Option Block on Monday.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.